Thank you everyone for joining today's webinar. It's a quite kind of like summer week, but it's a lot going on actually. Like just Nvidia just announced their earnings. There's a lot of actually earnings call recently on the AI companies, especially the portfolio company of our AGIX ETF. Just looking at today's performance, it's doing very well. That's kind of like in the mind of everybody. We're now like in the third year of AI, right? So everybody's like, either I own it or I have some way to get access to this. But as we think this is like a multi-year opportunity. And if you can get it right, you're probably going to have a good long-term result, benefiting from the AI revolution, I would say. So with that, I think like a lot of people also like curious, like what are we talking about today is like private AI unicorn in a ETF. That is right. So we're kind of like a pioneering in this, kind of like the ETF industry. As just like give a little background, KraneShares, we are we launched on firm on 2013. Now it's over like 12 years history, matched $11 billion across our 30 plus ETFs, mostly listed on New York Stock Exchange and NASDAQ. So anyone can buy it. So that's kind of like our business setup. We are kind of like want to be very innovative, bring high conviction ideas, hard to get access markets to our investors. So, like in history, we have been focused on a lot of categories, including a lot of China thematics, a lot of climate related alternatives, and also opportunities globally. So AI is one of our latest focus. We launched the AGIX ETF about a year ago, on July 17, 2024. That's kind of like the second year when everybody's already like widely used ChatGPT, getting used to, bring AI as part of their life in the work. But we don't think like most investors still is really lagging in terms of understanding the true power of AI and the potential of AI, or like how to really invest in AI. So that's why we partner with someone called Adna Capital Management. They are a bunch of AI native investors, engineers who are like venture capitalists being in an industry forever, investing. They're early investor in companies like Anthropic, XAI, Perplexity. You probably heard some of the names. Some are really leading financial large language model companies, foundational model companies like Anthropic, XAI. Some are like AI native applications like Perplexity, who claim to want to buy Chrome. If you watch this like news recently, so those companies are really the companies like driving this round of innovation. So when we look at the market, there's some AI products, mutual fund or ETFs, but none of them are backed by venture capital insights. Because if you're not really investing into those foundational model companies or AI native applications, you're not a situation where you're not like techie enough, right? You are a traditional like Wall Street guy or someone like me, sit on New York. You're not really situation where. So we need partners to talk to the foundational model company who know the feature of next generation of models, who knows how agentic AI going to deploy, which company going to benefit. So all those insights, we translate that into an index called Selective Etna Artificial General Intelligence Index. So there's AGIX ETF going to track that index. Basically, based on that AI score, that's going to pick the we call winners out of the whole AI. Every company going to claim we're AI company, but who's going to be the true AI companies, right? So that's a process we did for the public equity. But when we look at investment, there's something missing. How can you say you're investing in AI, this round of Gen AI, without investing into some critical companies in the model space or the AI native application space, because they're private. But even they're private, we're talking about like multi-billion or $100 billion valuation companies. If they IPO today, they could be part of the fund. So the idea is like, let's do a hybrid ETF that we can not only invest in the public listed company, but also the pre-IPO company in the ETF directly, because they know the companies. So with their introduction, we connected with the company like Anthropic, XAI, Perplexity, and we actually invested into Anthropic and XAI currently in the ETF. So that makes the fund quite unique to providing like access to the opportunity that's really critical for this round of Gen AI. So with that, we launched AGIX. Then we see everybody think, oh, this is thematic. This is another theme. It's going to be all like hype, bubble, then over. Well, when we look at the AI, there's a lot of themes, right? Like the short term, but AI fundamentally is more like a structural growth compared to a lot of other themes. Because just look at like this year, right? Like S&P was up like 10, 11%. Actually, 60% of that return contributed by AI names. So without AI, S&P is only like 3%, 4%. We have seen that trend like over the last 2 years. But if you're going back way over, you can see each time there's a technology breakthrough or new technology wave, you're going to have a bunch of companies that's driving the whole return of the equity market or the broad benchmarks like S&P 500 or NASDAQ 100. You starting from like the mainframe, then to the PC. With the PC, you build out a whole internet industry. Like then you have all the data now putting the cloud and SaaS opportunities driving the returns over the last decade. Those structural growths are really sustainable. There will be up and downs, but like if you happen to own those subsector of the equity market, you are likely to outperform the broad market equity return. And we believe the AI just started, right? Now we are in the third year. Think about like the early adoption, just like currently most people know ChatGPT, that's only consumer facing. That's a consumer opportunity. But if you look at like history, like what SaaS did and cloud did to really change the way that enterprise across American and the whole world actually operate, you realize that's a $1 trillion plus opportunity. And you probably realize that like that $1 trillion opportunity is much bigger compared to kind of like the early internet and PC opportunity. And also internet and PC opportunity is bigger than the mainframe because each technology breakthrough is based on the previous breakthrough, previous wave. You are building the multiple layers, right? The first layer, you have the hardwares and the softwares and internet built upon that. It's going to be bigger because it's leveraging that. And we have seen that for AI. This is the super cycle that is based on all the previous technology breakthrough. So it's going to bring a much larger opportunity going forward for multiple years. And we're now only 3 years from the start of AI. And that makes us believe like we should own some like early opportunity, right? Who's really disrupting this? Everybody's all NVIDIA, but like who's really using the technology to really bring the foundational model to power all the computing of the AI applications, the cloud computing, and all the adoptions is really the foundational model companies. So that's why we think having access early is important. So we are currently like shareholder of XAI and Anthropic. The AGIX on behalf of KraneShares Trust sit on the cap table. We added Anthropic on March 5th, 2025 through their Series E round of financing, and XAI on July 18th through their tender offer. So those are really our addition, our investment into private this year that become like making those two companies become part of the ETF holdings. So looking at like the access, right? A lot of people think like, if I want access to this private companies, I have to like be a credit investor. I have to pay 220 to the private and VC funds and lock up for 10 years. So that's very traditional ways to invest into the private companies. And there's some interval funds, right? So it's like between the traditional and the mutual fund, you lock up with like very uncertainty of like when you're gonna, what's the exposure you're gonna have with the quarterly liquidity. Then like the hybrid ETF, what we do is really in between the interval fund and traditional ETF, right? So think about traditional ETF, you have daily liquidity, but no private. But we have daily liquidity and with some private. So that, I think the number one question that people ask, like, how do you value those? Those are private company. So just like, and actually, we are kind of like one of the first firm doing that in the ETF world, but there's many companies have been doing that, like Fidelity, Barron's, and T. Rowe. They have been putting private companies in the mutual fund space. So we're just bring that best practice to the ETF industry. ETF end of the day is a 40 Act fund. So that makes like something, well, people should do that. But like, why is not? Well, it's not necessary, right? What's the rationale to invest into the private vehicle when you have good returns on the public, right? As a fact, right? The private investment is really different by the year you put your money. They call it vintage. So like early times, like when you putting in some like private companies, but like then all the IPO happening in 2021. Once you have like lockup expired, you probably like companies like a very poor performance. So that's really hurting people. Or then now thinking about like private companies, they have to consider a lot of things when they go public, right? There's tariff, there's like the president's tweet and other like policies, uncertainties, macro. Why bother, right? If I just want to do business well, I just want to grow my business. Anthropic, I think their annual recurring revenue was like about $1 billion last year. At July, I think it's now approaching like 4 to 5 billion. So that type of growth is like amazing. But like, if they're like a public company, they're gonna go through the April Liberation Day and everything like that. So that's kind of like I think like that's why a lot of companies, especially even companies like with valuation of hundreds of billions, they're choosing to stay in the private longer. So that's why I like investors to, if you missed out those opportunities, you probably missed out a lot for the private side. Because once they become IPO, it's really hard to get access. Actually, look at like now just recently, I think like look at the Circle, Figma, right, CoreWeave, those IPO markets being really coming back. So like if you think about like the potentially this cycle of the private market, especially what we did is really late stage pre-IPO companies like Anthropic and XAI, and potentially in the future as well as similar companies, is really capturing like this trend, right? The good companies tend to be in the private market longer, so you need to really get access. So haven't talked about the fair value, right? Like we are daily liquidity, so that's why we have just similar to what the practice that Vanguard, Fidelity, T. Rowe, and Barron's doing. They have a fair value committee. We do same. So we have a daily fair value committee to give a fair value to those private holdings. So that's reflecting in the NAV and the NAV, net asset value of the ETF. So that investor is really getting a fair value of those assets. And that's providing daily liquidity, and our AP is going to facilitate that. The public equity going to be in-kind transaction, and the private going to be cash transaction, creation and redemption for the ETF. So that's the mechanism of this fund. So that makes the fund unique because like you have access to some like companies probably you don't get access anywhere, right? So Anthropic, for people who are not familiar with that, they have a consumer-facing app called Claude. It's a competitor with the ChatGPT, backed by OpenAI. We think OpenAI is great because OpenAI is like kind of like the most popular consumer app in the Gen AI space. Everybody's like, if a consumer, you're gonna use ChatGPT because like it's famous, everybody knows it. But actually, if you're enterprise, things are a little bit different. For like, I think current stage of adoption, most enterprises using AI for, say, coding, right? So the highest adoption rate of company type is actually technology companies. So technology companies are using AI to read the automatic code and forming all kinds of workflow from the back end to the front end. That workflow automation can be really integrated with the autonomous decision maker of AI and agents. So those agentic AI solutions really now widely adopt in the technology space, and that's kind of like the fastest growing adoptions in the AI currently. And who's capturing that? Actually, we think Anthropic has the potential to really become a leader in that. If you happen to be a software engineer, or you know someone who's a software engineer who code every day, they're probably using like Cursor or the Claude coding. Cursor is also using Claude technology. So like eventually those like APIs, those traffics, those revenues are going to be passed through to the Anthropic's API. So that's kind of like the revenue making they're doing. This, as I said, the revenue has been growing very fast. It was just $1 billion annual revenue last year. Now is almost 4-5x. So that's really a competitive edge, I think, like in the enterprise world. And we believe enterprise AI is bigger than consumer AI, just like what happened to the internet previously, right? So there will be consumer AI native applications going forward, but I think at this stage, at least like next 2 to 3 years, the enterprise is going to be the main kind of like spender on AI. They're going to spend a lot of money. Think about like those technology companies, they're like $1 trillion in valuation. The tech industry is humongous. So the amount of money going to be spent to automate things going to be people not going to see in history, right? So we call that kind of like the AI revolution in the enterprise world. So I think this trend is way bigger than the SaaS and cloud. So if that's going to happen, the company is going to provide that solution to enterprise. It's going to be critical. We have seen some companies. We own some like companies in the public space, like ServiceNow, like Palantir, who really providing the either context layer or some like the automation layer in between like Anthropic and OpenAI and XAI, those foundation models, and their final use cases and application adoptions on the enterprise side. But we do think those foundational model companies going to take a large part of the revenue of across the value chain. For the XAI, we invest about like 1.5 million, I think, in July. So XAI is really a company we think is very special because of Elon and Elon's ecosystem, right? So Elon on Tesla, robotaxi, autonomous driving, owns SpaceX, owns like Neuralink. It's gonna do humanoid robotics. So all those things gonna relies on AI and data. So we feel like Elon's ecosystem is quite unique. They are unique in access. They have access to the social media data. They have access to the chips. They have access to all those kind of like travel data, driving data, humanoid data going forward. So all this data becomes so valuable for XAI going forward. That's why even though I think recently like XAI's Grok 4 model become the most intelligent model because they have like a lot of chips and a good algorithm as well. So that makes XAI a very exciting challengers actually to OpenAI and Anthropic. We're going to see Elon's going to bring XAI to a unique position within his ecosystem. So with those two companies, we build a portfolio actually around those foundational model companies. If you think about the stack of the AI ecosystem, you rely on foundational model to really taking input, generate output, or building AI agents. Then you need an infrastructure, right? The infrastructure is really the cloud, the data, the all the data preparation, the context, the model, everything that's supporting the model, computing. Then within that infrastructure, you need hardware companies, NVIDIA, of course, then other like energy related, like memories and manufacturing. Then you have AI applications that are going to use AI. That's going to either consumer side or enterprise side. So we have, as I said, we build this framework based on the insights of the AI researchers and venture capitalists who's really at the forefront of the AI investment in the private space. So their connections and their knowledge on the kind of like ecosystem is way better than me and many other like kind of like buy side analysts. So I would think like this is a framework that's gonna really dynamically capturing like who's gonna be really benefit from either disruption of the AI models or the disruption in the business model for a lot of companies, even the companies that we all know, like Google's, like AMD's, those companies somehow going to be disrupted. So how do you evaluate those impacts? And that's very dynamic every quarter. So we have this process to really identify the companies going to be in the portfolio, the weight. The process is really like rule-based, right? So we have a universe of 2,000 to 3,000 companies. It's like the AI industries, like that's very broad, right? So that then the critical part is the AI score, looking at the relevance and the readiness of the company. So based on the insights of AI engineers, and we're going to weight the companies based on the score and also the free float market cap. The index rebalanced quarterly with some capping on either categories or single companies. With that process, we can really identify companies that's really relevant and ready for AI. So for relevance is looking at like things like their revenue contribution from the AI product, how's their current product progress, because I think a lot of companies really developing and fine-tuning their product. So you have to check their progress and their readiness. So future revenue visibility, if they can really make money from AI, or they just like spend a lot of money and not able to make money. And how's their business model? When AI is going to disrupt it, when AI is going to make their business model weaker or stronger, right? So we want to really build a systematic framework, holistic framework actually for investor to really capture this long-term AI trend, but not worry, oh, I'm picking the wrong name or I'm like just betting all my money on one company. So like a basic approach is what do we think is the best for long-term, very diversified and the relevant approach to really capture this long-term trend. And we are kind of like we're diversified in terms like allocation as well. We diversified across all the AI stack, from hardware to infrastructure models to application. You can see the subsectors, sub themes within the each category, each stack. So, and this weight is also based on the AI score, so it's dynamic, right? So, I think this weighting has been changing. I remember like back in when we launched the fund a year ago, a lot of weight is in hardware. Then I think now a lot of like application infrastructure companies now becoming more crucial. Then they get a lot of the benefit, and the weight is more towards that. So going forward, it's going to be this trend is very similar, right? I think previous technology breakthrough, you have the value migrating from hardware to infrastructure applications. You have seen that in AI as well, but I think there will be some back and forth based on the latest dynamics and models and how the AI researcher thinks. So we have this quarterly process really dynamic allocating between the three stats. And the performance is showing that the AGIX has really outperformed major growth or technology index since we launched the fund on July 17, 2024. You can see that we are like about 30%. I think this data is outdated. Sorry, it's as of like July 25th. But as of today, we're like 38%. So that's something like I think like investors should compare themselves on Bloomberg or Yahoo or any or KraneShares.com/AGIX. You can see the performance of the fund compared to Nasdaq 100, technology sector index, S&P 500, or semiconductor index. You can see there's some major outperformance out there because the framework we talked about, and because we think this is a long-term trend to really identify the company going to truly benefit from the AI, capture this structural growth going forward. And AI is volatile because I think like just like any previous technology breakthrough, any technology, if you think about like NVIDIA, Amazon, Google, and Microsoft in the history, you have some meaningful drawdown. So that's kind of like, I want to remind everyone who's want to invest in technology and AI specifically, you should be careful if you're not really risk tolerant. So we think like AI at least has like a similar volatility compared to Nasdaq or technology sector. Just seems like semiconductor is more volatile, it's more like cyclical, but just generally technology has more volatility. But if you look at like AGIX risk-adjusted return, it's not really it's not actually taking a lot more risk compared to like Nasdaq or technology sector. Is less volatile than semiconductors. So that makes actually AI, if you have a long-term horizon and you have a good risk tolerance, it's good long-term investment to really grow the capital. So with that, I think I talked a lot, but happy to take questions. I've seen some like Q&A questions. So before I do that, I just want to thank Michael and everybody again to join this discussion. For AGIX, we are an ETF. We list the fund on Nasdaq, and the fund information is latest information is available on KraneShares.com/AGIX. And for anyone want to know more about KraneShares, please check our website. Please check out, we have several articles, webinars, and I think white papers on the AGIX fund. It's kind of like latest innovation. So there's a lot of questions people asking like, oh, how do you do private investment in ETF? How do you do that? So we have a white paper actually on our website, how to really unlock private markets with hybrid ETF. So you can check that. You're more interested into the mechanism of the fund. So with that, I'm gonna go through some like a disclosure. Have to take some questions, or we can chat more about the AI. Okay, so the first question is, I'm at OZEC. I do not have access to the CDI. How do I get it? So if you're like a financial advisor at a platform, you definitely can request it, and we can contact the platform really to onboard the ETF. So so far we just launched the fund on a year. So I think a lot of platforms require 1 year track records. We just passed that. So we are onboarding this fund to many platforms that currently. So yeah, it's great. Like you're interested. So let's do follow-ups. And if you have more questions, you can email us at info@KraneShares.com. We can do a little more follow-up discussions, and we can talk to your platform to really make sure like this ETF is available on your platform. We have a question from Hans. How will the private company positions work if the ETF has significant inflows? Will the position size be diluted? Short answer is yes. Since we are investing $1 million into Anthropic and $1.5 million into XAI on July, by the time we invested, I think is about like 8%, but with more flows coming in, the private going to be diluted. But also you have to consider the fair value, because I think we invest in Anthropic at a valuation of $61.5 billion. Now the company is talking to the next round, so which much higher valuation. So along the time, we have a fair value committee that considering all the information that we're gonna have a fair value of that. So the total value of the private gonna change as well. So all those factors gonna impact the real time weight of private exposure within the ETF. But how do we really prevent dilution going forward? As we grow the fund, we have a very strong pipeline that we work with our partner, Athena Capital Management. They're on the cap table of many AI companies. They have a close relationship with many AI companies, including first, we're on the cap table of Anthropic and XAI already. So if they do follow-up rounds, and we can actually participate in investing more if we have more money available. And the pipelines is really beyond that. We have been talking to many other companies like in the AI space. So that pipeline is very critical. So whenever we have a deal flow, a deal opportunity, we can take it. We can actually just adding more private company going forward once the fund becomes bigger. So generally we are talking investing about like 10% by the time we invest, and we can keep adding new names to the portfolio as the fund grows bigger. Okay, so Hans, you have another question. When new ETF shares are created, I assume new XAI shares cannot be purchased. Yes and no, right? So when that's what I answer, right? With the inflow, you're gonna have a new shares created. So the public equity gonna be in-kind creation. So our AP, our broker is gonna deliver the shares of those public equities, and the private portion is gonna be cash creation. So we're gonna receive cash. So we cannot invest in XAI directly at that moment. But as I said, we have a strong pipeline that's available. We're going to keep investing more money to target a decent weight of the private within the fund. So that's kind of like the plan for the ETF going forward, to maintain the right exposure to the private AI companies, as we talked about today.
Hey, Derek, I just wanted to ask a question as well. I'm talking about where you're allocating to private companies, public companies, et cetera. More like in terms of the segment of the AI ecosystem with hardware infrastructure, applications, et cetera. Which of those three areas do you think offers the most untapped potential in terms of AI?
So currently, I think a lot of people just don't have any exposure, any direct exposure to the model company. When you think about model companies, OpenAI, Anthropic, XAI, I think they should be part of the infrastructure, or they should be a standalone, actually. They're at the core of the ecosystem, right? Because think about like what is driving this round of innovation. ChatGPT everybody knows that. So people don't have access. So now what's driving mass enterprise AI is really Anthropic's API. All those like models really powering the AI agents to automate workflow for enterprises. People don't have access to those models as well. So those model companies, I think, is very unique. Is at the epicenter of this round of AI investment, but that's only in the private side. You do have a little exposure, like Microsoft on a little bit, some like OpenAI. You have the other like Google have this like Gemini. You have Facebook, Meta has like you have some models through like public holding Max 7, but like it's not direct. It's not really pure exposure to the model companies. Then I would think like application offer more opportunities going forward. Just like many technology breakthrough previously, like you do buy NVIDIA now, then you're gonna build out all the data centers. All those capex gonna be deployed, and they're gonna generate returns, cash flows are high going forward. But all that is based on the application, right? So previously, we have seen that trend similar in the internet, right? Like the consumer apps, enterprise apps, all those, then those apps, those software companies now becoming like now multi-billion dollars from a few hundred millions. So then now $1 trillion now. So that trend is similar, I think, going forward, where companies can really build out AI applications is going to capture a big part of the value going forward. So that's potentially, I think, a future investment we're going to focus on is really AI native applications, maybe on the private side and public side. So that's kind of like the forward planning. Yeah.
And then that relates as well to the AI score, right? When a company starts out being hundreds of millions and then goes to billions. So when you're adding private companies, you're looking at that they have a clear path towards monetization, right? And then how do you take that and work it into the AI score?
Yeah, so that's part of the score we calling revenue visibility. So basically means like they can really make money going forward. So if you think about like, there's a lot of AI companies. There's if you think about like many other AI ETF, there are like 70, 80 companies. That's any company putting AI in their description or prospectus, earnings call, it's going to be screened as an AI company by the index provider, then it's included in the ETF. So we don't like that approach because I think going forward, every company, AT&T going to say, we're going to use AI. Chase going to say, we're going to use AI. But doesn't mean like that's good investment. Well, potentially, but like that's really relevant for this structural growth. You really have to look at how much impact from AI to this business model and how much monetization they can make. And there even some pure AI companies, like Kuser, like I talked about, is the private company. But I think a lot of the revenue eventually going to be passed through to Anthropic because they pay Anthropic for API to really making that software service available. So themselves, if themselves is not making a lot of money, but actually they rely on another company, we don't think that that's like healthy. So similar to many other public AI application companies, I think like if the company just like wrapping AI with a very thin margin, they're really not really creating a business model that's going to be you have like this like a flying wheel of monetization. It's really hard. I think especially at this stage when everybody's questioning demonetization. So investors become more picky on companies. I think there'll be a lot of questions, a lot of cautious going forward. If just company claim to be from the earnings call, you probably noticed that a lot of companies that we don't own, but like people thought, oh, it's AI play, actually tanked after earnings call because it's not making money, right? So we have seen that trend for a year now. So that monetization, the business model is very important. And really, you need someone to assess that. You really need someone to be situation aware. You have to talk to the model companies, application companies, so who are they providing service to, and who's actually generating a healthy moat that can really make money going forward. Is critical. It's not just like do keyword searching and finding AI in their description.
Right. So then sort of a follow-up question from that would be, since you've been so involved in this space and you're critiquing and going over every company that's not only in your fund, but that you've decided to not have included in the fund, what surprises have you seen?
We have seen, like, I think it's a lot of companies that people ask, well, why are you not owning this? So we have to explain like why.
Right.
So it's like, it's a little bit risky because like, what if the company's actually doing well? But like after 1 year, I think like compared to our holdings to the companies we don't hold, actually is for the period, like we're doing okay. Just like when the earnings call come out, like a lot of business models really not really having moat, right? So they're just like on cybersecurity. A lot of people know one company. I'm not gonna say the name, but like it's like, oh, that's an AI play. It was like, no, it's not. It's like end to end. It's like traditional cybersecurity. It's not really integrated into the AI workflow. We're not including that. The investor is like pissed because he owns the name. So it's like, but like now after a year, he's like, okay, you're right. So we have several conversations like that because now everyone is like finding AI names. We have seen, oh yeah, some investor may be doing better than the fund, better than AGIX, but like we think like it's really hard to pick in several names and claims like, oh, I'm AI ready, because this industry is so dynamic. The business model is always changing. The capability of AI, of the models, of agentic AIs is evolving every day. Even like we make mistakes, right? Everybody make mistakes because nobody can see the future 100%, right? I think we live in the like time that technology breaks through so fast. You have to keep learning every day to really keep up. Oh, what is agentic AI? What is that? Like, so when we're talking about, I think like, especially in the financial industry, when we are doing a lot of discussion on AI, some terminology is like confusing. Like if you're not really following the industry, you have no idea what I'm talking about. So that's why you have to partner with like venture investors who come like, they're like one step ahead of us, like traditional public equity investors, because they know the upcoming stuff, they know the trend. So I think like you have to acknowledge that like there's limitation of information, knowledge, and insights we have. So keep learning, be humble, and just like keep like you can make mistakes, but like it's this long-term structural growth opportunity. So we have time to really adjust and adapt, so we can make right decision going forward.
Yeah. There's another question that's just come in on the Q&A, and that is, how are valuations impacting the strategy today and the returns going forward?
So that's a really good question, because it is really like a mindset, right? So if you think about like AI, if you think about like AI investment or technology investment generally in the past, you have like a period of usually like look at like S&P 500, right? Simple. The 101 is like buy low, sell high. When the valuation is high, you sell. When the valuation is low, you buy. And in the next 5 years, 10 years, you're going to doing better than others. That's still valid. I think it in terms of general equity investment, especially like S&P 500. But you have some period that the valuation is really not that relevant. When you have, I think this is especially true when the internet was really taking off, and you have a period for high forward PE, but the subsequent 5-year return and 10-year return is amazing. So why is that? Because the 4P is for 1 year Ps, really look at next year. And without taking consideration of the long-term growth rate, right? So when you have a growth rate like this at the early stage, you have to look at the end game. So in 5 years, in 10 years, how much money the company going to make? What's the revenue? What's the earnings? You cannot just linearly calculating the growth return and forecasting the 4 PE ratio and determine, oh, that's the valuation. So I think like traditional valuations becoming tricky for this type of investment, especially when AI is like internet, I believe. So I think like considering valuation is important on the short term, right? So it could be when sentiment change, when tariffs come, there's some like short-term disruption corrections, that those high forward PE companies tends to be sold by short-term investors. So like, it depends on the strategy. You can do that, of course, right? So you can do some trading, risk management. You can write you can do like hedging if you want to manage risk. But it's challenging. It's hard to time the market, and it's short term. Usually, each correction, just like what happened this April, right? We have a huge drawdown actually across the market, especially tech and AI. But the rebound is way bigger than the drawdown. And actually, looking at a year to date, the AGIX hugely outperformed S&P 500 and Nasdaq 100. So how do you really manage that risk? I think like just as I said, you either be patient, long-term horizon, and then just embracing it, or if you're more risk aware, you maybe do some hedging or like trading strategy to manage down the risk. But it's tricky. It's hard. I think a lot of people just missed it. A lot of friends like, oh, I sold like 50% of my portfolio during the April like tariff like other things. I never bought it back. Then I missed all the rally. So there's a risk upside as well. So just be careful. I think there's like just staying long term is a good strategy, but also if you want to manage risk, you got to be really smart, I guess. So okay, so I think there's next questions. Some of these companies are trading at 10x price to sales. Is that not a concern? How do you decipher who's going to win relative to extreme valuations? Yeah, so if some company is trading like 10x the PS, so that's something I think like really like I'm not gonna talk about each company. As I said, this like forward looking is only like 1 or 2 years, right? So you have to look at like longer term. Then companies like you have to really think about how the analyst usually, when you look at like I think like internet or like just like either industry analyst or macro analyst or economist tend to be very cautious. I think like when some technology breakthrough happen during the internet era, right? So you have a lot of cautious. Even like today, I think like people talking about inflation could be a very like trigger recession or stagflation. Well, I think like in the short term period, those inflation can be like where like the macro topic can really drive the sentiment around. But just like long term, you see technology is actually adding a lot of productivity. And usually the real productivity add is more than the economists or analysts forecasted. And that, if you have a longer horizon, that really has changed a lot of the GDP or assumptions or the earning growth assumptions and revenue growth assumptions for a lot of companies. So that makes, I think like in the short term, those macro and valuations and all those things matters. But in the long term, you have a long horizon, which I think I recommended for type of investment like this. You should have a very long horizon to really navigating through all the noises and all those kind of like corrections and disruptions along the way.